This is the calculator we are going to use to explain CGT transactions. Of course, if you have a certificate from a trust or an investment fund showing the base costs, proceeds or selling price and the gain or loss, then you certainly don't need a fancy calculator, as all the amounts you need are on the certificate for you, ready to enter into the ITR 12. You can simply enter and itemize the amounts on these certificates right here and show the base costs, proceeds and gain amounts straight from the certificates. I'll now click on the Itemize button to open the grid. However, you'll probably need help working out the gain amounts on other types of assets, because it can get quite involved, and for that we need the CGT calculator a bit lower down on the screen, where we can add as many different CGT transactions as we wish for a taxpayer. Different exclusions and exemptions apply to the disposal of different types of assets, so the nice thing about this calculator is that we can simply select the different types of asset by clicking on these buttons, and all the appropriate laws will be applied. You can see we have selected this particular asset as an other asset, as it is a second property as opposed to a primary residence or small business sale. Looking at this first very simple example, we can see that we bought this holiday house for R1 million and sold it for 6 million. So we made a profit of 5 million rand. The profit that SARS wants you to enter on the ITR 12 as code 4250 is the 5 million rand. SARS will apply any community of property splits, annual exclusions and inclusion rates. If I slide this window away, we will see the calculator has placed the 5 million profit under code 4250. The calculator has also subtracted the taxpayer's annual exclusion of 40,000 rand and worked out 40% of the balance as being 1,984,000 rand that will be added to normal taxable income in the assessment calculation. Sliding the calculator window back, we can see that the property was bought after capital gains tax came along in 2001. So working out what SARS calls the base cost and the profit is very simple. The base cost is the purchase price and the proceeds are the sale price. The proceeds less the base cost less certain other costs is the profit or gain. You may claim acquisition costs such as registration costs, legal fees to prove ownership of the asset, etc. Improvement costs you may claim do not include maintenance expenses. If you fix the garage roof, then that is maintenance and you cannot claim it. If you built an additional garage, then that's an improvement and you can claim that. Now, what if we'd bought this asset for R1 million before CGT was introduced on 1st of October 2001 and sold it for 3 million rand, giving us a profit of 2 million? Remember that only the portion of the profit which applies to the period after 1st of October 2001 is subject to capital gains tax. Fortunately, we had the asset valued at the time, and the value was 1.1 million on 1st of October 2001. This is our base cost, and the profit will be 3 million rand less the 1.1 million base cost, which is 1.9 million profit. What if we did not have the property valued on 1st of October 2001? Well, then we have to use what SARS calls the time apportioned base cost or TAB method to work out a deemed value or base cost on 1st of October 2001. Using the formulas in paragraph 30 of the 8th schedule to work out the time apportioned base cost can be very difficult, but let's have a look at some examples which we can work out manually. Let's get rid of the valuation amount and ask the calculator to work out a deemed valuation on 1st of October 2001. The calculator has used the formulas in the 8th schedule to work out a deemed value for the asset on 1st of October 2001. How did it do that? Well, it's a bit simpler than it may seem. You have to work out the total period of ownership of the asset and then proportion the profit over the whole period of ownership by the period before the 1st of October 2001 and the period of ownership after that. You count the number of years before the valuation date and after the valuation date. But remember that a part of a year, even one day, counts as a full year. From 8th of August 2000 to 1st of October 2001 is counted as 2 years. From 1st of October 2001 to the 7th of July 2019 is counted as 18 years. 2 years before the valuation date plus 18 years after the valuation date makes 20 years. If we divide the 2 million rand profit by 20, we get 100,000 rand profit per year. We add 100,000 rand for each year of ownership before 1st of October 2001 to the purchase price to get the base cost. This means we add 200,000 rand to the 1 million rand purchase price and we get a calculated or deemed value base cost on 1st of October of 1.2 million. Subtract this calculated base cost from our selling price of 3 million and we get a gain of 1.8 million. Now SARS has fine-tuned these rules a bit over the years and factoring in expenses and costs has become a bit simpler. For example, any acquisition costs and improvements made before the valuation date are now treated as if they were incurred on the date of purchase. If we say that acquisition costs and improvements before valuation date are 100,000 rand each and we reduce the purchase price by 200,000 rand, then we can see that our answer is the same. The calculator would add the 200,000 rand expenses to the new purchase price of 800,000 rand to make 1 million rand, so the gain answer is the same. The same sort of thing applies with sale costs. They are deemed to have taken place on the date of sale. If we add sale costs of 100,000 rand and increase the sale price by the same amount, we can see our answer is unchanged. However, if we add improvements made after the valuation date, then this does not just affect the sale price. The formulas amortize the improvement made after the valuation date over the period by effectively shifting the valuation date in the background and producing a new base cost, which means a new gain amount. If you want to use these formulas manually, then the formulas are freely available in the 8th schedule and on SARS's website in a document called Comprehensive Guide to Capital Gains Tax. Of course, WinTax does all these calculations for you.